Hello, my name is Valentin Khokhlov, and this is my investment club, the third issue. And today we'll talk about risks, because during our consideration of returns, I briefly mentioned different risk measures. And it's a good occasion to speak in more details regarding the risks and their measurement. And we will not speak about risk management, which is a separate topic and quite sophisticated. And I also apologize for 10 minutes delay. I had to finish my Russian speaking stream, which took longer than expected, basically, so my English speaking stream started just after the previous one. So apologies for that. And what we'll talk about risks, because actually you may even not be aware of some of the risks you are facing in your everyday life. So basically, let's suppose you have $100 note in your pocket, which is nice to have, basically, and it seems how it might be risky if you have this note in your wallet, in your pocket, but it's not that easy. Let's suppose that your domestic currency is not US dollar, so you basically have difference in currency rate. You don't know which currency rate will be in 1 year, in 1 month, and if you have expenses in your domestic currency, you don't know how many units of domestic currency those $100 will buy. So you face uncertainty in terms of your domestic currency amount, which is currency rate risk. Then somebody may steal your wallet, may just pickpocket you. So basically your $100 note may be gone for good or for not very good, and basically you can't just ignore that risk if you have if you have money in your pocket. But you can also face some action from government, such as a foreign currency ban, which is ridiculous basically in any developed country, but in many not so developed country it's still possible. It was definitely possible not so long ago, or like 10 years ago or 20 years ago. And in the Soviet Union, where I was born, for example, there was a criminal prosecution for foreign currency transactions. So basically, it may occur in some exotic countries. Well, let's suppose you put your money in a bank. Probably they won't take 100 US dollars, but maybe from 1,000 they start speaking to you. Basically, you face the same currency exchange rate risk. You also have a bankruptcy risk, because a bank might go out of business and your money are gone. Well, hopefully you'll get payment from a bank insurance scheme, because they exist in most developed countries. But still, bankruptcy risk, accounting errors. You may come to a bank and face that your account has zero balance because of some mistake. Hopefully it will be resolved pretty quickly, and nowadays you have information system which reduce such type of human factor mistakes, which was typical in our past, and everything was written down on a paper. So now it's quite rare, but still it may happen. And of course, government interventions such as mandatory currency conversion, or such as we had not so long ago in Cyprus, when the government converted some of the deposits, of large deposits of course, into bank equity when they had a bank crisis in Cyprus. So basically you can face any government intervention into your like bank accounts. Also, your money in bank, they are not liquid. If you need some money right now, you can't withdraw your deposit typically, and you may consider buying bonds. So basically, you went to a broker and buy bonds for 1,000 US dollars. Again, you see currency rate, which may change, and you have different amount of your domestic currency. But you also have many other kinds of risks you've never faced before. For example, you have interest rates risk. Let's suppose if you buy a bond for 1 year with maturity of 1 year, you get your 1,000 US dollars in 1 year. It's not a big deal. But if you buy a bond that matures in 10 years and you expect to sell it in 1 year, you may face a different price, because bond prices depend on the interest rates, and the interest rates basically go up, the bond prices go down, and vice versa. So the bond prices change, and you may face your bond worth less than the price you paid for it. So basically you face interest rate risks if you don't keep the bond until maturity. You may face the risk that there are no buyers for this bond. So you have the bond, you want to sell it to get money, and nobody wants to buy it. That may be the case. Then you have reinvestment risks. For example, you have a bond that pays 5% coupon annually or semi-annually. So you have $50 a year, you need to invest them, and it's not obvious what is the interest rates would be at the time you need to reinvest those proceeds. You may not face 5% yield anymore in future. Again, you have bankruptcy risk. The company or bank or whatever entity that issued the bond may go bankrupt. So basically you have no insurance for that. You have a possibility for exchanges or brokers' fault. Again, a human factor or IT factor, software failure, network failure. You may not connect to a broker when you need to transact because you have your internet connection down. It's also a possible risk if you need it quickly and you cannot do it. And if you consider buying stocks for 1,000 US dollars or more, 1 million for example, does not matter, you still face all the same risks. Currency rate, if you buy US stocks and you are in Eurozone, or if you buy stocks for British pounds and you are a US investor, the currency may go up or down, and your investment results will be affected by currency rates differential. Stock prices may go up and down, of course. They do every day. You are not guaranteed of any particular price, so basically always face price risk. You may also find the situation that there are no buyers. You want to sell stock, you cannot sell it. Of course, for very large corporations, it's impossible, almost impossible. It's always possible, but in practice, it's almost impossible for large companies. But for small companies, for exotic stocks, you may face the situation when there are no buyers. Again, reinvestments for your income, for example, dividends. bankruptcy. Company may go bankrupt. It happens. Exchanges of brokers may fail in their operations. Shut down, delays, lose your money, then they will reimburse you money, but the time is lost. Software failure, network failure, and of course government interventions are possible. Not only government, exchanges may stop trading. They have the right to stop trading if there's some disbursement on the market. Stock market goes up or goes down more than a specific threshold, and they stop trading just for the market to calm down. That's a possible case. And speaking of the recent event with GameStop, with Robinhood, you see many risks those guys who used Robinhood were not aware of. They materialized. Why? They thought they could use the situation when many hedge funds go short for GameStop stocks and buy those stocks, expecting the hedge funds to having to close their short positions and buying the stock for any price. It was kind of hype on the market, and it was quite possible, if those guys were aware of regulations, it was quite possible for stock exchange to stop the trades on this stock. It was possible for Robinhood as a broker to stop trading for several hours, for example. You have this risk if you use such a broker, and you need to be aware of those risks. There are many other kind of risks. As an investor in Ukraine, I face several risks you probably don't expect to face in your countries. For example, government stopped trades in one of stock I have called Motor Sich, one of major manufacturing factory here in Ukraine. Because of some corporate conflict, the stock transactions are stopped. I cannot do anything with my stock for more than a year now. And I also had some stocks in factories located in eastern Ukraine. Now it's a war zone since 2014. In some of factories, they don't exist anymore because they destroyed, they like ravaged, and equipment stolen by Russians, and Russians get that equipment into Russia, and basically they're thieves. They stole my property because I'm a shareholder. Well, I'm a shareholder, but the shares are worth nothing now, so I lost my money because of this political risk, which you probably don't anticipate in your countries. It happens. If you go to a stock market, you need to be prepared for that. So what is risk? The standard definition, how we define it in finance, it's the uncertainty of the future price of the assets, of the future cash flows. Uncertainty means you don't know how it go up or go down. Nobody knows. We categorize those risks into investment risk, which include market risks, prices for bonds, interest rates for assets in foreign currency, currency rate risk. So basically all of those are market risks. Then liquidity risk. If you can't find a counterparty, a buyer or a seller, so you cannot transact when you want to do it, it's a liquidity risk. Market is illiquid. Or if you face a significant bid-ask spread, so difference in prices, because there are some bids, but too few of them, so it's also liquidity risk because you can transact, but at a very inconvenient price, unprofitable maybe even price. So liquidity risk not only no buyers or sellers, but also the amount of spread. Then the concentration risk, if you have one stock or one position in your portfolio, it's a concentrated portfolio, you face the risk of this particular asset. If you diversify your portfolio, you mitigate this risk by spreading it across many assets. Then you have credit risk, the bankruptcy basically. If a company goes bankrupt or counterparty cannot fulfill its obligations, it may be counterparty of futures or forward contract or swap, basically it's also credit risk. Then the reinvestment risk, if you cannot reinvest your cash proceeds with the same rate of return as before, it's reinvestment risk. Then time or horizon risk, it typically is essential for pension plans, for like retirement planning. If you like miscalculate the time horizon until the pension, until the retirement, or time horizon after retirement, you may face a shortage of cash or inappropriate portfolio composition. It's time horizon risk. Very specific one, we will not speak about it actually. So next category is operational risks. Many of those related to the operations of companies, brokers, exchanges, government intervention. But we can start with failure, crashes, disasters, terrorist attacks like 9/11. All those go into operational risks. Then human factor. Involuntary mistakes, errors. Whenever you have humans, you have mistakes. Nowadays, less than before, because many things are automated and kept in the information systems. There are less human factor, but you still have voluntary actions like thefts, misappropriations, misconduct. They still remain, and they will always remain, whatever information system you will use. Then trading stops or disruptions, like for GameStop, for Robinhood, when the trade stopped, or you were not able to buy stock, you were able to sell it, or vice versa. So any restrictions they put, brokers or stock exchanges or regulators, all that disrupts free trades, it's your operational risk. So basically take it, you cannot avoid it. And of course such ridiculous actions like expropriations, nationalizations, or confiscations, all the bad stuff the governments can do, and they occasionally do in not very developed countries. So you need to be aware of that, and you cannot avoid it. And as in case of Ukraine, the war with Russia, basically, who could predict it 10 years ago? Nobody. War in Europe seemed impossible. And then business risks, we'll not talk about them actually, because they relate not to investment but to business management, such as demand for your goods or services, and competition in the industry, and strategy, flawed strategy, irrelevant strategy, outdated strategy, or a business model. Is it relevant? Is it successful? Competitive? So basically all of those leads to business risk, which are particular to companies and their management, not to investors. Basically, we in our first stream we consider different investors, and different investors have different key risks, because if you are an idea-driven investor with a very long time horizon, you basically do not care about trade disruptions, because you are indifferent if you buy the stock today or tomorrow in 1 month. It doesn't matter. But you are very sensitive to market risks, and maybe time horizon risk, and maybe also a concentration risk. But if you use technical analysis, if you use day trading, if you use trading on charts, you basically have very short time horizon, and you don't care about many things like bankruptcy, because it's very like negligent probability if the company goes bankrupt right in like 1 hour that you kept this security, or reinvestment risk, for example. You don't get current income with this style of investing. You just get capital gains in very short terms, and you basically don't care. You reinvest your proceeds from closed position immediately, basically. So you don't have reinvestment risk. And what you face as a such type of investor, you face trade disruptions, you face like failures of exchanges or brokers, because you need to close this position right now, not tomorrow, not in 2 hours. Maybe in 2 hours it might be late, and if your network connection goes down and you came back in 2 hours, the market may go far away from your target levels. And if you had the possibility to gain a profit and close a position in 15 minutes or in half an hour, that opportunity might be gone for good or for bad in 2 hours, if you were not able to transact in a timely manner. But if you have a fundamental analysis, if you analyze a company using discount cash flows or multiples or whatever valuation model you may have, you basically are indifferent to those trade disruptions, because you have 1 year time horizon. You expect the price to converge to intrinsic value in 1 year. You don't care if the market is open now or is closed. And you don't care about going in or out of business in a very short term. But you face model risk. I forgot to mention about the model risk before, because if you have a flawed model, or like garbage in, garbage out, you have garbage inputs, you have garbage output in terms of your target price, and you misprice your valuation. Basically, you have very wrong target, and you do a wrong action. And you wait for 1 year, and then it turns out your model was very poorly specified. For factor investors, the same relates, but to multi-factor models. Again, you misjudge on the factors or miscalculate their sensitivities, and the market goes not in the way you predict, and basically all your complicated, sophisticated models, they go into trash bin. And classic portfolio management, if you miscalculate returns or risks or volatilities, you also may make very wrong portfolio decisions, but you are irrelevant to short-term market disruptions, again, because you only rebalance a portfolio once in a quarter, or once in a year, or maybe once in a month, but not more frequent. So basically, different investors, different styles face different key risks. So now let's talk about how we measure risk in a classic portfolio management. So the full risk, it was initially specified in the portfolio theory as volatility of returns. It considers both upside and downside deviations from the expected returns, that means from the average. And the standard deviation formula you see here, you see a return during specific time point less average. So you have this difference squared, and sum of those squared differences you divide to the number of observations less 1, or the number of observations, and here's the trick. because you have sample standard deviation with t minus 1, or you have population standard deviation with just t, when it does matter. Let's open the data file. Let's open the data file. So here's a function called stdev. Both in Excel and in Google Sheets you have the same. And I calculated for S&P 500 ETF called SPY for more than 10 years, daily returns. It's daily standard deviation. It's not annualized. To annualize, we need to multiply by square root of trading days per year, approximately 252. But here we have daily. And it's sample, because standard function called stdev, it gives you sample standard deviation. It's a kind of obsolete function. In modern versions, it's called also stdev.s because it's sample. You see here the same value. But you may find a different value for function called stdev.p. It's population standard deviation, a slightly different denominator. Why and how it may matter? If you use variance, which is square of standard deviation, you have also difference between sample and population. Here population and here sample. Excuse me. And if you have so-called covariances, which are very important for portfolio optimization, and if you use function called covar, which takes two parameters, so you use covariance between two data arrays, and if you put both arguments, the same array for both arguments, you have variance here, and you see this variance equals to population variance, because function covar, it uses the same denominator as population based variance and population based standard deviation. So in order to make your calculation consistent for portfolio optimization, if you use covar function, you need to use population-based standard deviation and variance. Otherwise, you'll introduce small discrepancy in your calculations, which will lead to some discrepancies in the output of your optimization model. And if you use stdev standard, stdev or stdev.s, or the corresponding variance.s, you need to adjust your covariances for that. Of course, there may be a covar.s function, or you may calculate it manually, because you see this formula, you can put adjustment for this value to convert sample to population and vice versa. So how we calculate the portfolio risk? You see this formula here. This last three terms is actually covariance. So covariance is the product of correlation and two standard deviations. And correlation is a very important concept as well. You may face so-called correlation matrix in addition to covariance. Covariance matrix is specific to portfolio optimization. You find it only in that context, and correlation matrix you may face more frequent. Here it is. So this on a reddish background. What it means? When you have correlation of 1, it's in diagonal, because you have the same array, and correlation is 1 for the same array. And if you have different arrays, the closer the correlation to 1, the closer the dynamics of two return series are. For example, you see SPY, S&P 500, is highly correlated with tracking portfolios, with 5 assets tracking portfolio and 15 assets tracking portfolio. And those tracking portfolios are also closely correlated to one another because those are supposed to track the performance of this index. But the other portfolios are less correlated. For example, US aggressive portfolio or US balanced portfolio. The correlation about 0.6. And BRIC portfolio has very low correlation, and it's expected because BRIC portfolio has majority of non-US stocks, so it's less correlated with the US stock market. So you see the strength of relationship between two returns of two portfolios is measured by correlation, and when you multiply correlations by standard deviations, you have covariances like this one. So let's get back to our presentation. When you measure the results of portfolio management, the efficiency, you have several indicators. One is Sharpe ratio, which is the difference between the portfolio return and the risk-free rate divided by the full risk of the portfolio as measured by the standard deviation. And what is the risk-free rate? As I said before, there is no risk-free asset perfectly risk-free. All assets are risky, but there is a convention in finance that we choose one asset that is particularly low risk, that has no risks of, for example, credit risk or currency exchange risk or liquidity risk, and we call it risk-free, and they are the short-term government bonds. Why? Because government can always literally print money to fund their debts. So basically no credit risk if the bonds are denominated in domestic currency. Again, the bonds are denominated in the same currency as your portfolio, so no currency risk. And the government bonds are typically liquid, so no liquidity risk. So you see, many risks are gone, and so we call it risk-free rate. And we also have so-called risk-adjusted performance, or M squared. How to understand this indicator? Well, you have the risk-free rate and portfolio less risk-free return differential multiplied by relative risk benchmark, which is market, to portfolio. Why you use this adjustment? Let's suppose your portfolio has is 2 times riskier than the market. So this adjustment is 1 divided by 2, so 50%. In order to get the same M squared, you need to have a higher return on your portfolio, which should be so that high that this expression should be 2 times larger than the same expression for the market portfolio. If it's hard to understand like that, you can regroup this expression. So if you deduct risk-free rate from both parts and divide by this term, by standard deviation of the benchmark, you will see here you will have the Sharpe ratio of the portfolio, and here you will have the Sharpe ratio of the corresponding market portfolio. So basically all the portfolios with the same M squared will also have the same Sharpe ratio. So it is the indicator which is equivalent to the Sharpe ratio, but unlike the Sharpe ratio, it's expressed as the returns in %. So that's why it's called risk-adjusted performance or risk adjusted return. But it's very rarely used, not very popular. Sharpe ratio is almost always used. You will find it frequently in investment presentations, prospects, and other presentations. So let's switch to systematic risk, which means the sensitivity of the asset or portfolio returns to the market or index return, and it's measured. The popular measure is beta, which is calculated as follows. So you have the covariance of the asset and the market divided by the variance of the market. And the covariance we can express as correlation multiplied by 2 standard deviations. So basically you have here the sensitivity and the portfolio beta is just a weighted sum of asset betas. So it's very easily calculated. This similar to Sharpe ratio is Traynor ratio, but it uses the beta in the denominator. So it tells you how much return you get for the unit of systematic risk. Why beta is important, why it's so popular? It became popular after the development of so-called CAPM or capital assets pricing model. It's 70s, early 70s of the last century. And this model tells that under very strict assumptions, but roughly speaking, if the market is in equilibrium, the expected return, it says about the expected return on the asset, it should equal to risk-free return plus beta of the asset multiplied by the difference between market return and risk-free return. Again, expected market return to be fully correct. Of course, the actual return does not need to equal to the expected return. Maybe higher or lower, and there is another metric called Jensen's alpha, and this alpha is the actual return less the expected return. So if the alpha is positive, it means the actual return was higher than expected for this level of systematic risk. So the investment manager did a good job. If alpha is negative, the investment management did a poor job, and you were better off with investing to some other asset. Because if the market is in equilibrium, the market alpha is 0. So some assets are above market with positive alphas, and the other are with negative alphas, and they are worse than the market. So that's the sense. So you always should get the return corresponding to the level of your systematic risk. That's why beta became important. If the market is assumed to be in equilibrium. And how it works in practice. Let's see how it's calculated. So to calculate, it can be calculated actually very simple. You have slope function. Slope takes two arrays. One is your portfolio and second is your benchmark. Or the order of the arguments does not matter, so you can specify in any order. But one should be your portfolio and another one should be your benchmark. And here the benchmark is SPY, which is S&P 500 tracking index. And you see the portfolios have different betas. And this is slope, very easily calculated, but you have a different function as well, which is much more sophisticated, and it's called LinEst, which is linear regression estimation. The coefficient, so-called regression coefficient, is actually the same as beta, because it's the slope, And here the second coefficient is intercept, which is the intercept. If you draw the line, it will intercept the y-axis at this level. And you also have standard errors here, and here you have so-called R squared. What is important about this R squared? It's so-called the share of the volatility in the asset returns that is explained by the volatility of the market returns. So roughly 42%, 43% in this case of the volatility in aggressive US portfolio is due to the market volatility, and the rest is due to other factors, so-called unsystematic risk or idiosyncratic risk. And this R squared is actually directly related to the correlation. It's the square of the correlation. So I'll calculate the correlation between the daily returns of S&P and US aggressive daily returns. The correlation squared equals exactly to R squared here in linearest results. So basically, if you have a linear regression, you will have actually three terms there. One term, so you regress US agro returns, your portfolio returns against SPY returns, against the S&P 500 returns. So first term is the regression term, so regression coefficient multiplied by SPY returns. The second term is constant, which is intercept, and the third term, it is not indicated here, but it is the error term, the regression error. And this regression error corresponds to all the risks not catched by this regression. So basically, if we get back to the presentation, the unsystematic risk that catches everything else is calculated in a very simple manner actually. So you have the full risk, which is your standard deviation squared or your variance, and you deduct the portion that corresponds to systematic risk, which is your beta multiplied by the variance of the market, so squared standard deviation of the market. So this part is the variance explained by the variance of the market. So it's roughly, in our case, 43%. And the rest goes here to this term, which is called unsystematic risk, which is also the variance of the residual. Those errors, they denoted as epsilon, they also called the residuals. So this variance of the residual, it catches all the rest except the market volatility. And that's why it's unsystematic part. And if you have many assets in your portfolios, this part, the market risk, will be the same. So the systematic risk will catch everything related to stock market. And it will be like the same, different amount, of course, because the beta is different, but the same risk exposure to the market. And this part, for every asset, it might be significant, but it will go down, with each additional asset you add to the portfolio. So if you add 20 or 30 or 50 assets, this part for the portfolio becomes less and less because this is fixed, and I mean for each asset, and this roughly remains the same. So this part for the portfolio goes down and down with diversification. So it's said that you get rid of this unsystematic risk. with diversification. That's why, basically. Okay, let's go to the next risk, downside risk, because many investors say we don't care about volatility in upside because it's good. We only care about volatility in downside because it's our loss. Let's consider only that part. Well, if we considered only volatility below a certain threshold, we can choose any threshold, 0, risk-free rate, or some target return. We calculate so-called semi-standard deviation, which is about the same as standard deviation, but we only consider those observations that are less than R0. R0 is our threshold. And in the denominator, we typically calculate the number of those observations, or the number less one. But there are people who say it's not consistent, because if we have downside semi-standard deviation and we have upside, which would be sigma plus, and this will be for returns higher than the threshold, the sum of those, well, technically the sum of squares of those should equal to full squared standard deviation, but it will only happen if the denominators are the same. And in order for the denominators to be the same, you need to put the number of observations here, and it will be the different indicator. And then if you calculate so-called Sortino ratio, which is portfolio return less your threshold and divided by semi-standard deviation, or standard semi-deviation, I don't remember exactly, probably semi-standard deviation. So if you divide by this measure, you get the Sortino ratio. But if you use different threshold, you have this value calculated in a different way. And if you have a different way of calculating the denominator, you will also have different Sortino ratio. So in order to calculate Sortino ratio, you need to know both your threshold and the way the denominator is calculated. Well, let's see how it works on practice. Okay, waiting for this file to load. One moment, please. So here we have several portfolios again, and the first one is SPY, so the same S&P 500 tracking ETF. Here we have daily returns in this column, and in column O you have data for Sortino ratio calculation, or semi-standard deviation calculation. How I do it? I use if function. So if the return is less than the daily risk-free rate, I use the difference between this return and the daily risk-free rate squared. So this squared value is here. If the daily return is higher than the threshold, I put empty cell here. So I ignore this cell. And I do it for every observation. And then let me scroll down. At the very end, I calculate the number of non-empty cells, which means the number of days when the return was lower than the threshold. And then I calculate the semi-standard deviation. I use the sum of squares I have in this column. I divide by the number of those non-empty cells less 1 to be consistent with the sample standard deviation. And I take the square root of those. Okay, this is daily semi-standard deviation. Then I annualize it by using the square root of the amount of the observations per year, for example, if this is annual measure, and you see it's 13% per year. It's the annual semi-standard deviation. And then I use the sorting ratio for SPY. I get the portfolio return annualized as well. I get the risk-free rate annualized as well. So I deduct risk-free rate from the portfolio return and I divide it by the annualized semi-standard deviation. And that is the sorting ratio. That's how it's calculated. And the next risk measure called tracking error. So I mentioned in our last stream as well, it's a measure relevant to tracking portfolios, and it measures the difference between the portfolio and the benchmark returns, and you take the volatility of this tracking error, and the volatility is standard deviation. So you get two samples, portfolio returns and benchmark returns. You deduct benchmark returns from the portfolio returns and you get a sample of differences. And then you calculate the standard deviation of this sample. So it's here, the formula is here. So the squared standard deviation or variance of this difference and square root of that. And you can actually express it as variance of the portfolio plus variance of the benchmark less two covariances. Very easy to calculate, but rarely used in practice. How to calculate using the first formula? Actually, it's not difficult. It's quite simple in a spreadsheet. Again, we go to our first data file where we have daily returns. Let's see, US aggressive portfolio is our portfolio, SPY S&P 500 is our benchmark, and TEV here. So for Google Sheets, I have array formulas. For Microsoft Excel, you use array formula, you enter it using Ctrl-Shift-Enter. So you have standard deviation of this difference. So you see portfolio returns less benchmark returns, then you calculate the standard deviation of those, and to annualize you multiply by square root of the number of trading days. If you use Microsoft Excel, you enter this formula and press Ctrl-Shift-Enter and you are done. For Google Sheets, I have to add this array formula in order to achieve the same. And to calculate information ratio, I use portfolio return less benchmark return and divide by the TEV, by the tracking error volatility. So that's pretty easy, basically. And you see the information ratio formula here in the presentation. It's the same as I entered into the spreadsheet. Okay, so for whom this tracking error is relevant? For ETFs, for passive strategies, mutual funds, and how I know that it's relevant and they use it in practice, I just open some website. Okay. So what does it say? It says the fund. Basically, fund is based on tracking difference, which is the difference between portfolio returns and benchmark returns, and tracking errors, which is defined as the annualized volatility of the difference. So you see both factors. Those factors we don't cover now, they are more specialized. And here you see tracking difference which is the difference in returns, portfolio less benchmark. Then you see tracking error, what we have just discussed, and the information ratio, again what we have just discussed. And then you see the systematic risk, beta and alpha. Again, we discussed it already in the stream. You understand what beta means, what alpha means. Alpha is positive, fund manager did a good job. And here you see annualized return for the fund and annualized volatility, which is standard deviation for the fund, the full risk here. And then you have the Sharpe ratio. Again, what we have just discussed, it's full risk measure, it's the systematic risk measure, and it's the tracking risk measure. Everything we have just discussed you will find in such sites or in a fund prospectus, not here, not in iShares.com site, but if you open Blackrock site and if you open Blackrock prospectus for this fund, you will see information ratio, tracking error, but for this iShares site they only provide standard deviation and beta, only those two measures, and that's it. And the fund manager Blackrock, basically, so Blackrock has on their site more like detailed overview of this fund. Okay, so what we have to discuss is the last risk measure, and then we are done with this stream. The last risk measure called VAR, or value at risk, and it's the amount of losses, so that the probability of a bigger loss is equal to a given value, for example 5%. So it's the amount of loss that you can achieve on the portfolio with the probability of 5%. And you have a sample percentile, the statistical measure, 5%, 1%, whatever percent you specify. And it's important to understand that this is a threshold. It's not the amount of loss. So basically you will get the loss larger or bigger than this threshold. What loss you get? VAR does not say. It only says you'll get loss larger than this threshold. And if you calculate it with the sample data, it's simple. I will show in a minute how to calculate it from the data sample. Well, one moment, I will switch to the presentation because I forgot to switch, sorry. So you see now the definition, and if you are interested in the amount of loss, not just the threshold value, you need to consider so-called CVAR, or conditional value at risk. What does it mean? It's the expected value of losses bigger than the VAR. So you get the threshold and you consider only those losses that are bigger than this threshold, and then you get the expected value for those. And if you use sample, it's just the average loss larger than VAR. It is important that VAR and CVAR, they are measured in money, in US dollars, for example. But in order to make those independent of the portfolio value, if we divide it by the initial value of the portfolio, we get them in percents, the same way as we do with returns. So if we express VAR and CVAR in percentages, we need to divide by initial value of the portfolio, and then we work with them as with the returns, and we use the return sample. And now I can show you how it works. Just one more observation. CVAR is called a coherent risk measure. VAR is not a coherent risk measure. It's quite important to statistical and risk management applications. But for us now it's not very essential, but roughly speaking, CVAR is better than var for many practical instances. But how to calculate them if you have historical returns data? Again, we get to our data file, and to calculate var we use percentile function. Very easy. We specify the data array, our data sample of returns, and we specify the percentage. So I use 5% of worst occasions and 1% of worst occasions. So 5% for SPY was minus 1.63%, and 1% var 3.14%. Of course, the definition of var is in terms of losses, so you don't need to use minus here. But minus, I use minus because I use the returns, not losses. So it's just the opposite value. And for other portfolios as well, I use percentile function, very easy. And how to calculate CVAR? CVAR is the average loss larger than var. In terms of returns, it's the like average return lower than this negative var. So I use this sum if and the count if functions. First, for the numerator, I use sum if for this data sample, daily returns, and I use a condition if I consider the sum of the values that are less than this var. So I calculate the sum of the values lower than the var. And I divide it by the count if, so I divide it by the number of those values. So if I use the sum and divide by the number, I get the average value. So that is the CVAR by definition. And you see here the CVAR 5%, CVAR 1%. Sometimes you may hear var 95%, var 99%. It's the same. So 5% because I use 5% of the worst observations. And if we convert it to the losses, it will be not 5% but 25%, because it's like 5% of upper values. And for 1% of worst returns, you have to use 1% of highest losses. So it will be 99% like quantile. But it doesn't matter, because you know, if you have 5% or 25% or 95%, sorry, or 5 or 95, it's the same, and 1% or 99%, it's also the same. Of course, you need to put minus here, because I use returns, and if you use losses, you don't need minus, you need like to take the opposite value. Excuse me. And so you see, if we have var here for SPY 1.63%, we have CVAR 2.69%. But if we use for var for brick, we have 2.18%, but the CVAR is 4%, roughly 2 times more. So you see, even if you have this var, your expected loss will be almost 2 times higher. But for other portfolios, the difference is not such significant. For example, well, it is significant, but not so large, because for US balanced, the var is 1.24%, the CVAR is 1.96%. It's not 2 times, but it's roughly 1.5 to 2 times difference between those. So you need to know if you have this VAR threshold, your expected loss will be higher. And how to see it, how to get the visual representation. You need to put so-called frequency chart or histogram here, and the VAR will be in this tail. So you get like 5% of worst observations roughly here, somewhere here, and you see how many observations you have in this tail, in this left tail. And CVAR will be the average of this left tail. So the exact numbers we have just seen in our previous data sheet. But here you see the number. You see, for example, if we take 3%, how many values returns lower than minus 3%? So losses higher than 3% we have. For SPY, we have 34 such occurrences in more than 10 years. 34 days in more than 10 years. But for aggressive portfolio, it's 2 times more. It's 68 occurrences, 68 days when those losses were higher than 3%. And for US balanced portfolio, only 15. So you see, it's very it's very straightforward way to see how risky different portfolios are in terms of significant losses. So balanced portfolio roughly 2 times less risky than the benchmark, than SPY, and US aggressive portfolio is roughly 2 times more risky in this left tail. So it's 4 times as risky as a US aggressive portfolio, just by the number of occurrences. Of course, here you don't see it on VAR or CVAR. You don't see 4 times difference, because those are averages, not the number of occurrences. Still, those tail risk measures, they are quite popular, and especially in banking sector, when you have VAR as standard risk measure and CVAR gaining more and more popularity recently. In addition to those classic measures that we use in portfolio management as standard deviation and beta, Sharpe ratio, and tracking error volatility. So that's basically it in terms of risks and risks measures and calculation tips for those. Basically, we have considered everything of importance to portfolio investors. We haven't considered VAR and CVAR in much details. We'll probably do a separate stream for that, because to calculate theoretical VAR, CVAR, we need to cover many specialized topics in probabilities distribution, which is a very special topic. It's not that easy, and it takes time, it takes effort, so we will not speak about that today. And for today we are done, so I thank you for attention, and have a good day. Goodbye.